Here. All right, session 12. We are officially done with the mining application data collection. And now we are going to dive in to the loan program education mining scenarios. So there's a lot of different programs here. It's really important, I think, just for you guys to understand in this particular industry that, part of consulting and really is that you have to have knowledge to give, right? Like you can't sit in front of somebody and give them wisdom that you don't have. You obviously have to start somewhere, but people are running into problems all the time and they're trying to figure out, how do I connect the dots? And so part of what you're trying to do is to figure out and solve. We've been designing products ourselves for clients around this concept of frustration. I was just meeting with one of the largest groups here in town today, and they do tons of industrial. In fact, they're probably the largest spec industrial developer in the state. And they just lost JP Morgan as an equity investor. And so they're trying to solve these problems, and they can't get debt. They can't get construction debt. There's a $500 million project they're trying to do, and they can't seem to find the debt financing. And so we get to come in and help solve some of these problems by bringing some of the programs we've created that are still active and so on and so forth. So you constantly need to know what you're talking about to be able to have this bandwidth to go, okay, here's all these problems, and then how would I kind of piecemeal this together to solve it? So as we go through that, just be thinking, it's not just about learning a program, the pros and cons, but it's also about solving problems. That's what you're really in the business doing, developing a relationship and solving a problem. Okay. That's how you add tremendous value to people's lives, solving a problem. If you're the cancer doctor and you're the guy, like my friend had cancer on his lower spine, and he flew all the way across to Indiana to meet with this guy, and he helped, rid of the cancer. This guy's solving a massive problem for people. And so there's a tremendous value that he offers to people. So just always think that way, whether it's here or wherever, that you're really if you want to have tremendous success, then you'll be a great problem solver. Does that make sense? So 504 program, who wants to take a crack at this funky program?
Well, it's a small business loan that has lower interest rates and has a lower down payment.
Mm-hmm.
Yeah,
go ahead.
I was just gonna say it's usually for a single use building, so like your gas stations, some restaurants, car washes, bowling alleys, laundromat.
Yeah, it could be for those, could be for anything, really. I mean, you think about so if you look in the world of small business, okay, and I'm a guy that's buying a building and I have options. My options are, you pay cash, right? Probably not going to happen. The second one is you go get a bank loan, which is a conventional owner-occupied loan, and you're going to put 20% to 25% down. So just start doing the math. If I'm buying a $2 million building, okay, and all of a sudden I'm starting to go, gosh, I'm putting down 400 to 500,000 bucks. That's a lot of cash for a small business owner to pony up to buy a building. And what do you think he or she could be doing with that cash? They could be putting it back in the business and doing what they need to do, as opposed to plopping it into a building that they're just occupying. Okay. So that's there. And I'm not saying it's bad. It's just tougher for them to do. And so if I'm the small business owner and I walk up to the bank and say, hey, I want to borrow money, then what the government has provided or offered through banks, okay, so you have all these banks all over the country, and they're set up, and then you have these other institutions. So you got bank, borrower, and CDC. Okay. CDCs are certified development corporations. Okay. They are non-profit by nature. And what they do is they will underwrite the transaction that a borrower is going to do. And then what they'll do is they will go ahead and approve to provide these bonds on the loan. So there's really, the way it's structured is you have this bank over here that says, I will fund half of the loan, 50%. So what's half of $2 million? If you guys don't get this one, I'm going to call your
A
teacher.
million.
So half of it is $1 million. And then what do you do over here is the CDC, the Certified Development Corporation, will come in and they will provide 40%. Okay. So you got 50% from the bank, which they're doing a first deed of trust, taking a lien on the property. Certified Development Corporation comes in, puts a second behind the first, okay? And it takes them up to 90% of the whole stack, okay? And what ends up happening is that debenture, that's what they call it, it's a bond, it's a debenture or a second, is they'll fix it for 20 to 25 years. Okay. So 20 to 25 years is how long they fix it for. And their rates are significantly, well, can be significantly lower than most of the banks. Okay, because most banks are not going to finance and fund something for 25 years. They're not going to fix it for 25 years. Okay, so I'm going to show you here in a second what the rates are. If we can get this here. So loans, resource, your rates.
I know it's 10% in most cases, but what happens when it's less than 10%?
So meaning like what if the, what do you mean by that? I just want to make sure I'm answering your question.
Because there's 50% from the third party and then 40% 40% from the CDC, and then 10% for the small business owner. So I remember it saying that in most cases it's 10% for the down payment, but is it ever lower or higher?
Yes. And that's a great question. If it's a special use property, what do you guys think I mean by a special use property?
They get specified for one use.
Correct. So like what types of properties would classify like that?
Car wash, gas station, potentially a restaurant.
Exactly. Yep. Be very hard to, turn a car wash into an industrial building, right? It's a long bay with, essentially vacuums. It's a piece of land. So they're usually going to have you put 5% more down. So 15. Now, why do you think they would do that?
Just because, like, if you were to foreclose and not pick back the debt and they had to sell that property, it's probably going to be a lot harder to find a specific someone to fill that unit.
That's right. Yep. Very hard. It's riskier. Remember, everything you're dealing with is risk. So it's a riskier proposition. Now, here's the 504 rate history. So look what happened. Look all the way at January of this year. What was that 25-year fixed rate?
3.2%.
Look what happened here in June.
Way up.
Look here, October. Right? So, you know, and look at this. Way back here last year. 2.692. That's free money. Okay. Now, if you went to a conventional bank and said, fix my rate for 25 years, they'd be like 9%. Now, why do you think that the bank, well, let me ask you this. Why do you think these guys can get away with fixing it for 25 years at lower rates?
Because they're not putting as much equity at stake. Like they're not filling 90 or 85%.
It's a good shot, but I want you to think about who's backing that loan on that CDC. Who's guaranteeing it that if it goes default?
The government.
So it's a bond, okay? It's going to get sold into the secondary market when it closes. So somebody's going to go buy that, okay? And so they're looking at it as if it's almost a treasury type of thing. So if remember, if the risk is lower on something, the credit default on something, then that means the return is what? Higher or lower?
Lower.
It's lower. I mean, think about this. If you go and, like, we'll go back to the Midland. If I buy an asset with Joe's barbecue shop in Midland, there's one location, or I go into Uptown Dallas and I buy a CVS Walgreens or CVS, right? Then what do you think? Am I going to pay a premium for that CVS? The answer is yes. Now think about it. I'm going to pay a premium because it's lower risk, which means my rate of return is going to be lower.
What are you saying from the bank's perspective or the?
Well, just think about this. So CVS is a huge credit, right? And they sign a lease, and I'm buying that property with that lease as the backstop. Means that if they default, it's highly unlikely they're not going to pay. Okay. If Joe's barbecue shop in Midland, that is riskier because I'm in a riskier market. Okay, that's the first piece. And then secondly is that tenant is riskier. Why do you think they're more risky than CVS?
Their own business rather than a big corporation.
Exactly. How many locations do you think CVS has? Hundreds of thousands, right? Just tons. And they've got this huge corporate balance sheet that's guaranteeing it. Joe's barbecue shop may be great food, but if times get tough and the oil world dies off, then they're kind of like, crap, can't pay this rent anymore and there's nothing you're going to do. So you're up a creek. So you better be getting a lot higher of a rate of return for that risk that you're taking. Okay, you guys tracking with me on this?
Yeah.
So I've got a friend over in Texas. He specializes in helping people buy stuff in Midland. Okay. He's having a tough time. I mean, you know, it's hard enough as it is when market is good. But, you know, now he's struggling. So you just have to think in terms of risk and return. So for a federal bond, what's the likelihood they're not going to pay or make sure those get paid on that particular, you know, bond?
I mean, a lot lower than,
A lot lower. So that means the rate of return is what?
lower.
It's lower, right? I mean, and just think about it in terms of if you guys are all lending money, if you said, hey, Dave, I've got this great opportunity. You could lend money to my buddy. He's buying a house and he's going to put 50% down on this house that he's buying for a good price versus my other buddy who's buying a house and he's only putting 10% down, right? It's just a riskier proposition because if he defaults on the 10%, then, you know, I'm kind of like, oh crap, I don't have a lot of room for margin. But the 50% guy, I'm like, I'll probably get less of a return, but I have a lower risk. You guys tracking with me?
Mhm.
Make sure you're not checking out into Lululand over there. Just so the idea is like so I'm trying to help you just see on the CDC side that they're going to give a lower rate but they just have a lower risk because it's the government. Assuming that you still have confidence in the government, but it is nevertheless, okay? So that's kind of how that works. You have this, so repeat it back to me. So how does the structure work again? One of you guys take a shot at it.
So, I mean, so for like the 504,
Yep.
so it's an SBA loan that's usually 70 to 75% guaranteed. It's less risky because the government is backing it. So you're going to get a lower interest rate on it.
And then what's the structure of it who's doing what in the transaction?
So 50% is going to be from the bank, 40% is going to be from the CDC,
Yep.
and then 10% is going to be the borrower.
That's right. Yeah, 100%. So that's how it's structured. So think about this for a minute. How many people are underwriting that loan? It's two, right? Got a bank and the CDC. So they're both underwriting. So you're having to give information to a lender and the CDC. Okay. And you're going to have to give them this information. So there's a lot more red tape, a lot more paperwork. So it's just a little bit more of a challenging type of loan. Now on that CDC portion, do you guys remember what the prepayment penalty was? It's a 10-year declining. Do you guys remember what do I mean by a 10-year declining?
So like it goes down every year. So let's say like 10 years is a 10% prepayment, 9 is 9%, 8 is 8.
Exactly. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Now, what's a little bit unique about this product is that it literally rolls each year. So it's not quite the full amount, meaning that it's not 9%, it might be 8.75. And the next year it might be 7. So it just kind of rolls and gets lower and lower as you get lower. But ultimately is a declining step down prepay. So what does that mean if you're explaining it to a client? If you're sitting across from a client, he says, what do you mean I have to pay? You know, what does that mean when you say declining prepay? How would you try to describe that to somebody?
Making up for the time that they shorten through the whole term.
Correct. But like, why does a lender put a prepayment penalty on there to begin with? What do you think?
Because they want consistent money.
Yeah, they want to make sure they stay in the loan and de-incentivize you to pay them off. Now, why would they do that? Why do you think they would de-incentivize you to want to pay the loan off?
I mean, so they can make more money on interest over time, as opposed to you making it early.
Yeah.
Paying it early.
You doing okay? Got a little.
Yeah, no, I just choked the floor. Yeah, that's exactly what happened.
Done that one. So, you know, if I'm lending money to you and I have to go through the brain damage of getting all the documents, collecting your paperwork, doing all this stuff, I don't want you to pay me off too fast because I want to make money and keep making it consistently every month. And so I'm going to de-incentivize you by saying I'm putting a prepayment penalty in. So I'm saying, look, you can pay me off, but you're going to pay for it in this penalty so that I'm not stuck having to go back out. Because what am I have to do when I get my money back? What am I going to do with it? What do you think?
You'll loan it off to somebody else.
Yeah, you can go lend it to somebody else, but that means you have to go find another loan, right? But what if you don't have one? What if it's just like, or you find a bunch of crappy ones? And so now you're just stuck sitting on this money that you're probably paying money on, by the way, to the depositors. Okay, so it's like you're losing money when you're sitting on these loans. So you're trying to get that money just working for you, churning, okay, all the time. And so that's why they put prepayment penalties in. Life companies, remember, do heavy prepayment penalties because they really want you to just sort of like, you know, the old infomercial, set it and forget it, you know. So they just kind of, there's this idea, they just want to put it to bed and be done with it, okay? So you got to explain that to a client. He says, oh, okay, now I understand, but he or she still says, well, how much is that going to cost me? How are you going to explain to them how much it will actually cost to pay it off? What would you do?
I mean, you could probably just make a chart of year by year and show them the difference based on the percentages.
Exactly. So you say, look, you know, year two, you know, let's say you have an outstanding balance of, you know, $1.8 million and you got 9%. You're going to pay $162,000. Now, does that start to change things when you're visually hearing that about a prepayment penalty?
Definitely.
Like, whoa, I got to pay that much? Yeah, that's how much it is. So you're trying to help them understand it. Okay. So you've got a bank doing that. Do you guys remember what kind of terms the bank offers on the first that's doing the 50%?
Sorry, what did you say?
As far as like the interest rate?
Yeah, like what do you guys think I mean when I say terms?
The amortization schedule and
Yeah. Yep. Amortization schedule. And then remember term. Okay. So there's amortization and then term is what? What do I mean by term?
so like annual, semi-annual, like the amount of payments.
No, but nice shot. It's actually the period of time where the loan matures. Okay. So the term is when that loan matures, when it's done, means it's due. Okay. You guys might think in terms of, you know, like when you go into a residential loan, okay, And a residential loan, 95% of the time, is a 30-year fixed loan and a 30-year term. So that means you never have a balloon. Do you guys know what I mean when I say a balloon? So a balloon payment is synonymous with term. Means that what happens is if I amortize it over 25 years, but I have a 10-year term, okay, that means the loan comes due in 10 years. You tracking with me? So I calculate your payments on a 25-year schedule, but I'm actually ballooning your payment. Your whole loan is coming due in 10 years.
So basically you just have cheaper payments for 15 years, but it's those other 10 years of payments are all due at once at that.
That's right. It is. So let's just take a look here for a minute. So let's just say your loan is 2 million. Okay. And let's just say it's 6%. And let's say it's a 25-year amortization. Get rid of all this stuff. Oops. I think it just cut something off. Okay. So I'll just shut that off. Okay. So the first thing is, so notice this. What is that?
Monthly payment.
It's the monthly payment. Okay. Now watch what happens to the monthly payment if I change that amortization. What just happened to it?
That was.
Yeah, went up, right? So that amortization is the thing that calculates your payment along with the interest rate, obviously. So now if I say, well, it's due in 10 years. So how many months is 10 years?
120.
So 120. So I'm going to go down here to month 120. There's, October 19th, 2032. You guys will be a little bit older and I'll be a lot older, right? So all of a sudden, here's the principal and interest and how much is due at that time. Started with 2 million. How much is due now?
1.5.
Yeah, so $1,527,039.61, right? So that loan is going to mature or balloon or term out in the 10th year. Now, your initial reaction is kind of like, well, crap. I don't have $1,527,039.61 to cut a check. Okay, so why do you think a lender would bother going through the exercise of putting a term on it or a balloon?
Do you refinance at this point?
Yeah, you do. Booyah. You refinance. Or, I mean, maybe you're really rich and you just pay it off. You could, right? But most people don't. Most people are going to refinance. But my question is, why do you think they would even bother going through the exercise of putting a term on it? Any ideas?
To make it look more appealing.
It's a nice try. Yeah. Look more appealing. What do you think? Let you take a shot. What do you think, Zach? Why would they put a balloon on it?
If it comes down to it, maybe you have that extra 15 years to make smaller payments.
Well, no, look, I'm trying to just get you guys to think a little bit here. I'm not trying to make you look silly. I'm just wanting to have you kind of participate in this. But the purpose of it, which I still don't fully understand, honestly, is supposedly because remember, they're regulated by the government, and the government said because they're larger loans, we consider them more risky, and so we want balloons on them to really just keep people incentivized to keep things up to par. Now that still doesn't make any sense to me personally. I'm not sure how that mitigates any risk. But you know, it is the government. So go ahead. Were you going to say something?
I was just saying that doesn't make much sense.
Yeah, it does. There's not a lot of logic to it. I haven't been able to track with it. I've been trying to wonder why. But nonetheless, what it does do is it forces the client to have to refinance. It also, I think the only thing that could potentially be wise that, you know, if interest rates have adjusted significantly higher, okay, and you're getting a lot lower of a rate and you have to balloon and refinance now as the lender, you're actually going to get back to a level of the economic, you know, industry, right? So if you lent originally at 5 and all of a sudden the market's at 7.5 and you've been stuck at 5 for 10 years, now all of a sudden it recapitulates and you can get back to 7.5. Does that make sense?
Yeah, so it's basically just like, so people aren't, they're getting a really, really good deal or getting screwed out of a bad deal if they were to have a super high interest rate.
Correct. Yeah, and so it's like it, you know, could go favorably for you or it could go the opposite direction. So, you know, it just sort of depends on where you're at in the cycle, you know, the interest rate environment. Like right now, if you're ballooning on your loan payment in this environment, you're probably kind of going gulp, right? Because you're going, crap, I'm going to have to pay 6.5 to 7% right now versus I may have been at 2.5 to 3. So that's a big jump. So but it's important to understand that, just to kind of go, okay, that I understand the mechanism and why. So the bank comes in and provides 50%, 25-year amortization, probably going to do a 10-year term, but they usually only fix it for 5 years. Okay. Lenders like to do shorter term rates. And the reason why is kind of like what we just discussed. They don't like to, it's risky if they lock it too long and the rates go much higher, is they're stuck with a lower payment. What they call it is economic loss. What do you think I mean by economic loss? So if the market is 7.5 and I'm at 5, why is that an economic loss? It's not a physical loss. You're not actually losing money physically, but there is an economic loss in that.
Do I mean kind of like what you're saying the last one, like it's not par with everybody else. There's a 2% gap.
Yes, correct. I'm economically losing technically, right? On that money should be getting this, but it's not. It's getting this. So in a sense, I'm losing inflationary wise on that money. Does that make sense? Mm-hmm. It's kind of like if I locked in a lease payment of, you know, for you guys renting an apartment complex from me, and I say, you know, we just signed a lease for $1,500 a month, and then all of a sudden, you know, 6 months down the road or something, the leases are $2,000. I'm technically kind of losing $500 a month, right? That's why, you know, if you've ever rented before and you all of a sudden you get your renewal and a raising rental environment, you kind of go, crap. How come I just went from this to this? You know, it's heavy. So, so that's kind of how it works. So again, bank 50%, CDC fixes the whole time. There is no balloon. And remember something, if they're doing construction, okay, so if they're doing a construction loan, then is the CDC involved in the construction loan? Is the CDC involved? Do they actually physically put out money during the construction period, the CDC, the Certified Development Corporation?
I would say no.
That's correct. No, it's not. Now, the reason why is the CDC, remember, it's a bond. They're not in the business of actually like doing construction distributions. They just fix a rate and put it to bed. Okay. So they don't really get involved in construction. Now they will commit to it up front. Okay. So if all of a sudden, Ben and Zach Incorporated comes and says, we're building a building, David, and we want to get a 504 loan. You will actually go through the process of getting approved, okay, from the CDC, but you will essentially not actually distribute the money until such a time the construction is complete. Okay, so what do you think I mean by that? So they'll approve the loan, but they're not going to actually give you the money until such a time that the construction is complete.
I mean, just to make sure that the project, goes well during this construction phase. They're not taking upon that risk until they actually see that it's done.
Yeah, they're approving the loan, meaning they're saying, we will fund your loan. We will give you the money, but we're not going to give you money during construction, okay? Because they're not in the construction business. But who's going to fund the construction then? If the CDC doesn't? Remember, the bank does 50% first, but who else is going to fund the construction loan? Because you still have another 40% that needs to be funded. Do you think it's going to be the borrower that's going to have to just pony that up? So
It's not the bank or the borrower.
Well, I didn't say that. I'm saying
I guess the bank would have to help out again.
they would have to do it. So the bank will go ahead and they will fund a first at 50%, and they will do a second, their own second. Okay. So they do their own first and they do their own second of 40%. So, and why do you think they do it that way as opposed to just doing 90% in one loan? Why do you think they would put a first for 50% and then a second for 40?
I guess it's less risky to default on two than one.
Good try, but no. So think about this. When the time comes that the loan is going to mature, meaning that the loan hits C of O, or certificate of occupancy, okay, then all of a sudden, when that CDC comes in and says, we want to add our 40% in, if they had one big loan, they'd have to absolutely redo that whole loan. But if they do a first for 50 and a second for 40, the CDC can just take out that 40%. Okay. So all they do is it's kind of like a 2-layer cake, right? You just slice that top layer off, put in the 40% from the CDC. That's why they do it. So they do their own first, they write a first deed of trust, they write their own second deed of trust, and then they come in and insert and just take that out when it's done. Okay.
So they have just like a type of insurance, basically.
Yeah, ultimately they're funding it themselves. The bank is actually going to fund 90%, but they do need to secure their own position, right? So they, go ahead.
So they're not swapping those loans; they're just replacing.
It's almost like a refinance of that second.
Okay.
Yeah. So what they're doing is, when you write a first deed of trust, you're actually going to the title company, filing a deed of trust against the property as a first deed, okay? Which means you have priority on that property. So if you ever foreclose, you're going to be the first one to get your money back. You have priority. That's why it's first, right? If somebody comes and does a second, well, they're in second position, which means if the first forecloses and there's no equity left, guess what happens to the second? So if they get paid back and they foreclose on the property and they get their first back, but there's no equity left, what happens to the second?
also forecloses.
Well, it is foreclosing, but there's no equity left, so it just gets wiped out. Like nobody's going to get paid back. So if I lent you money and somebody had a $100,000 first, and you said, I need money, and at the time there was equity, and I said, well, I'll give you $50,000 and I'm going to put a second behind the first. But all of a sudden the market crashed and that property is only worth 90,000. Well, you got $150,000 on a $90,000 property. So it's $60,000 under market. So that means when that person gets their 90,000 back when they foreclose by liquidating the property and selling it, guess what happens to me? Nothing. I'm done. Like I just lost my money. Does that make sense?
Yeah.
Okay. So it's a risky proposition to be in a debenture position a second, because there is a potential, if there is a drop in value in a foreclosure, that I'll lose my money. You guys tracking with me on that? Because if not, I want to make sure I explain it again.
I understand it.
Yeah, got it.
Okay. So my point is they're doing their own first and their own second. Okay. So it's not like technically risky per se for them, because they're just doing their own first and second. You know, they're not going to wipe their own second out. Now if the property goes belly up, that's a whole nother issue. But ultimately, when they get the certificate of occupancy, the CDC will go out, secure their funds, take out that second. Now they're fixed for the 25 years at the time they close. Okay, so remember, I showed you those rates. So here's the risky part. Remember, we were all the way back in the 3s in January?
Yeah.
So if you did that loan in January, okay, and you're like, cool, I'm going to get a really low rate, but you're doing construction, and all of a sudden you're like close to being done with the construction. Now you're looking at it going, oh crap, my rate's going to be like 6.5%. Okay. You're not locking your rate until you actually close. Okay. So, because construction rates are floating rates, they don't fix. But when you get to the permanent side and it's done, then you fix. So you could be screwed in that particular case. Okay. So don't be deceived. It seems like a good program. The problem is, what I always explain to clients is, it could be good for you, there's no doubt, but you do run the risk that if you get done with construction and the market went wonky, then you're stuck. And you know, now here's your rate. Okay. So just kind of understand those mechanisms. That's sort of what you deal with in construction. Now the 504 loan, it's going to take you probably 75 to 80 days to close. It's a lot of red tape. Okay, so I always want you to remember, government loan, red tape. Do those two go together? Yes. You guys ever been down to the MVD?
The
Motor vehicle department, right? Getting your license, getting something done, right? Government run organization, right? Red tape, slow. Okay, those two just go hand in glove. So just recognize that about 70% of the paperwork on there is probably worthless. Means it has no relevance to really the loan. It's just somebody upstairs in Washington thought it was a good idea to slap on a bunch of paperwork that really has no relevance. So ultimately, the 504 loan serves a purpose. It allows people, you know, I guess my question to you is, why, if someone has to go through all this red tape and brain damage, why do they do it?
to get a lower rate that's less risky.
Yeah, exactly. That one of the reasons is, you know, you potentially get a lower rate and you fix it for long, right? That's absolutely correct. What's the other reason? Because you have your options: pay cash, get a bank loan, or do a SBA loan. So just think about the two loan, the bank loan that I set up first versus this one. What's the big difference? Besides the interest rate and fixed for 20 years, 25.
Less equity.
Booyah. Less equity. I'm putting 10% down versus 25. Okay. Is that a big deal for a small business owner?
Huge.
It's huge. I mean, for someone's running a small business, they're going, dude, if I have to cut a check of less than 250,000 versus 450, that's a lot of dough. Okay. So, you know, that's a big deal for people to say, I'm willing to go through the brain damage to do that. And not everybody does it, but you know, it is there. So that is the attractiveness, in my opinion, probably those two major reasons. The other reason, go ahead, Ben.
So I know like Integrity Capital's big thing is like closing down the underwriting time and like making it shorter.
That's correct.
So like obviously, so if somebody did a 504 where somebody else, I guess the average would be 75 to 80. What would that be with? I guess
Well, with us, we just don't like to do them flat out. I mean, so because we don't have control over the government. So our whole thing is we're going to build products that compete with it, that ultimately we don't have to do it, because it's just literally you're just literally this I hate using the word victim, but in a sense you are. You're just sort of, you know, stuck with their ginormous red tape flags. You know, there's just nothing you can do.
Sure.
So we just try to avoid them at all costs. We've done plenty of them in the past. That's why we're very familiar with them and we've done them. But it's part of the reason we've designed the way we have designed, is because they're such a pain in the butt. But they do serve a purpose. So I'm not trying to completely bash them, but you know, in terms of our process, it's a nightmare. And people are usually exhausted and frustrated at the end. It's just not a good client experience when at the end everybody's just kind of burned out, tired, frustrated, you know, annoyed. And it doesn't matter how many times up front you tell them, like, dude, this can be a long, drawn out, frustrating process, which isn't a good way to kick off a, you know, relationship. You know, hey, we're going to date, but I just want you to know in advance, it's going to be really a nightmare, you know? So, you know, great, let's go. You know, but you know, at the end of the day, you know, we have to be upfront with them, but nevertheless, they still get halfway in the middle and go, this is a nightmare. And my response is, I know. I don't have anything else to say than that. So it is out there. It is available. We're not huge fans. Obviously, doesn't fit our culture, but it serves a purpose. And, you know, so the other reason too, that someone would do a 504 is if it's a startup. If you try to go get a startup loan with a bank loan, good luck. It's just not going to happen. You have no history. You know, if you're a startup, it's what you are. You have no revenue history, and you're very risky. You know, so banks just not going to touch it. They want to see history of cash flow. 504 can get around that. From the bank's perspective, if you're the one doing the first deed of trust on the 504, you're in a pretty good position, right? Because you're like 50%. So if you foreclose, you're like, hey, I'm in good position. I'm half. So I'm fine with it.
Are 504s typically pretty successful, or do they default a lot?
You know, I would say that it's pretty small default rate. Just because they have to go through such a nightmare of, you know, paperwork. And they really want to make sure that it's going to be successful. So yeah, they're generally not going to default, although it can happen, you know, restaurants and, you know, the economy turns, it can definitely get mucky for sure.
So the government does have like a pretty hard underwriting process besides the whole length of it.
They do. I mean, you have to do a business plan. I mean, there's just so many things you have to do. They ask tons of questions. So it's very thorough. But they're probably, I mean, getting these types of loans is good for the bank, especially for a 7A loan, which we'll talk about next. I don't know if we'll get to it today. I might just give a quick overview, but it's backed, right? So if all of a sudden you default, government's going to step in and rescue it, and make sure that the bank gets made whole. So that person who just bought the bond is going to get made whole because the government guarantees it, and they're going to pay that back, so you don't lose your money. So if you're an institution buying a big bucket of 504 loans from the CDC because they sell them as bonds, you're in pretty good place. And so you enjoy buying those. I mean, it's probably not a bad thing to buy them right now because you're getting a pretty good yield at 6%, 6.5%, and you got government rated stuff. That's not a bad thing to do. Lock in your rate right now. So that's why those prices go down. So that's the 504 program. The 7A, do you guys remember the difference between the 7A and the 504? 504, remember, is 2 loans.
I have SBA guaranteeing 75% of loan amount.
That's right. So the SBA guarantees 75%. So who's actually cutting the check when you get to close? Is it the SBA or is it the bank?
SBA.
Yeah.
It's not the SBA, it's the bank. Now remember, the SBA is like an insurance policy. They are saying we will guarantee in the 7A loan your loan by 75% of the loan, but we're not cutting the check. You are. So the bank is the one literally writing the loan amount and giving you the physical money to buy the building. Does that make sense?
So the bank is giving you the full check, but you're guaranteeing 75% of that.
Yeah. So well, there's a couple of elements. So let's go through the thing. So borrowers borrowing the money. So let's say that that's Zach and Ben are physically borrowing the money. They're buying it. You're buying a building. You're borrowing. You put your down payment to buy the building, and then you're getting the rest from the bank. Okay. So the bank is physically cutting you a check for the 90% of the purchase price. Okay. So it comes out of their kit, their coffer. They cut the check, you pay it and buy the building. Now you owe them the 90%. The government, their role is they're saying to the bank, okay, bank, you followed all of our standards. We will go ahead and issue you this, guarantee document, which basically says if you ever have to foreclose on this property and you liquidate the property and there is no, there is no equity anymore, then we will step in and we will replenish your money that you originally put out because you don't have any equity to get it back, of 75% of the dollar that you lose, right? I'm not going to give you the full dollar. We'll give you 75 cents of the dollar, but you're still getting 75 cents, which isn't bad, right? Like that's better than zero.
Yeah.
So that's how it works, the mechanism itself. Now the government will say, kind of like an insurance policy. Remember how if you look at an insurance policy, they'll have all these little, asterisks and, therefores and depends and et cetera, et cetera. It's kind of like, well, as long as you maintained this, then we'll pay you. as long as you did this, then we'll pay you. So they have all these little outs, right? Of how they get out of paying you. The government, I got in a car accident years ago, and I remember I had to go through the whole process of getting the insurance company to pay for the claims. Man, it was like World War II trying to get them to pay, because they're just kind of like trying. I'm like, wait a minute, I've been paying you for 15 years, and like I have to fight you to try to pay my claims. They're going to try to find a million ways to get out of it, So, it's kind of like the government does that too. Is they're like, well, as long as you did this and this and this and this and this and this. So that's why they're so thorough, because they want to make sure that's an ironclad guaranteed government, thing. They don't want to go back and say, well, you didn't do that, so we're not going to give it to you. I'm sorry. So they're super strict. Okay. So I think that's enough for today, in terms of this long